Hello and welcome to Views from the Top, Livewire's new series dedicated to sharing the investment ideas and views of those who spent decades in the industry. Today we're very lucky to be joined by Jackie Fernley. She's the CIO of Mason Stevens. She'll be sharing where she believes we could be in the market cycle, as well as some of the fund managers she's been recommending to her clients today. Thank you so much for joining me today, Jackie. I'm really excited for this chat.
Thanks, Ali. It's so good to be here.
Before we start, I'd love to know a little bit more about you. For those that don't know you, can you tell us a little bit about yourself?
Sure. So I've been in markets for almost 30 years and I started my career in equities, direct equities. I'm a bottom-up fund manager, stock picker by trade, and over the last 5 years have shifted more into a multi-asset investment process. And I really enjoy and love and have a lot of passion for markets. And before I stop telling you about myself, I think I listened to a podcast just in the last day or so which said we need to be more than our careers. So as you present who you are, to actually present something else. So I'm a mother of two. I have a son who's 23, a daughter who's 21, and I love to cook and walk and yoga and really just enjoy friends and family.
Yeah, we're definitely way more than just our work. Let's talk about work now. Let's talk about markets. Where do you think we are in the market cycle?
So one of our key things that when I talk to clients and work with clients is to always try and anchor to a market regime. Markets are really chaotic and really noisy. So if we anchor to a framework, it makes our thinking more workable. We can make better investment decisions. So when I think about regimes, I think about inflation and growth as the two key drivers, the direction of both, and in what combination. So when we think about the regimes, we would think about inflation down and growth up. That's a Goldilocks environment, and in the environment of today, that is your immaculate disinflation, soft landing narrative. In an environment where it's growth up and inflation up, that's reflation, and that's your no landing China strength narrative. Then if we turn to the next regime, it's inflation, which not surprisingly is inflation up but growth down, and then deflation, which is inflation down and growth down. That normally comes with a phase 2 credit cycle and is normally quite disruptive to risk markets. And what is the most difficult thing about markets right now is that the probabilities attached to those 4 quadrants have moved materially. But what works in a Goldilocks environment does not work in a deflationary environment, and the probabilities are somewhat equally weighted between deflation and Goldilocks right now based on the economic data coming through. And that's why markets are rallying on the hope that it is actually a Goldilocks regime.
What do you think though?
The $64 million question. The answer is I don't know. And if anyone sits with you and tells you that they do, I'd run away, because we don't know. This cycle could be different or it could be the same. We are watching some clear data points, and we can talk about them in due course to work through whether or not this recession that we've all talked about for an extended period of time has been delayed rather than denied. But the answer is I don't know.
Okay. I want to talk a little bit more about the macro. Is there a possibility that the cycle has changed, given that we've been in this almost modern monetary experiment created by central banks?
Yeah, unconventional monetary policy, a whole host of activity that we've never seen before. And I think the important thing to understand is that economists, as wonderful as they are, look to history to determine the future. Yeah. And if the environment is changed or the rules of the engagement have changed, then the models are only as good as the data that's going in and the nature of the history and the process. So what that means is yes, in history, when this happened, that happened, but in the future, with unconventional monetary policy, does that mean it will happen this time? And the difference this time is our starting point. We've had an extraordinary 3 years in markets with COVID hitting, with an enormous amount of monetary policy and fiscal stimulus all hitting at the same time, which essentially built a corporate balance sheet and a household balance sheet that has been stronger than we've ever seen before. So that is buffering what has been, again, an extraordinary monetary policy normalisation with 500 odd basis points shift in 12 months. We don't know what is actually going to happen, but what we're seeing is a level of resilience in the US economy and globally to an extent that has surprised most pundits. And it's a question of, does that strength and the speed or the slowness essentially of the impact of the monetary policy mean that we'll have a different path? Again, I don't know the answer, but it's the things that we're watching.
Yeah. I know this question wasn't on the run sheet, but I want to know, do the risks outweigh, I guess, any of the benefits of raising rates further for the Fed, for example, where we are today?
Yeah, it's an often conversation that we have around what is the intention of Powell and the Fed in general. Does Powell want to be remembered as the Fed chair who allowed inflation to run rampant or not? I think we can answer that they don't, or he doesn't. But it's interesting as we start to listen to his narrative that the pendulum is shifting a little bit to growth. It's still very much anchored to inflation, and certainly in an RBA setting we've seen low jockey between one and the other. But do we actually have a Fed put involved in markets today? I'm not so sure we will necessarily see the rate cuts immediately, but we've certainly had a Fed put in terms of banking stability. Yeah. And so, I think they're doing a reasonably good job at this point in time in allowing the economy to actually balance itself out, and we'll see if we get this soft landing. Let's hope so.
Okay, with all that in mind, how are you positioning portfolios today? What are some of the fund managers that you're recommending to your clients?
Yeah. So with probabilities shifting between Goldilocks and deflation over the last few months, we have added back to risk assets. We are still sitting slightly underweight our strategic asset allocation in both domestic equities and international equities. But as we put money back to work, we have been adding it to sectors in the market that are less expensive. So by that I mean, in the Australian context, we have actually been allocating to small cap fund managers. And we have a couple that are our preferences. Spheria is one, but we also use OC and OFIA as our three preferreds in the space. And I think there's a long track record of not only those fund managers, but small companies in general, where the fund managers actually add alpha consistently over time. And so we've started to put money back to work in that space. And in a global setting, we've actually been utilising an S&P equal weight instrument. So QUS is the code that we've chosen, but there are others. We wanted to actually tilt our portfolios toward the economy that has actually been incrementally better, which is the US economy, and equal weight insofar as the multiples attached to the S&P that X the big seven or the fabulous seven are actually sort of largely in line, slightly above long run averages. It's far less expensive. So using an equal weight instrument gives you exposure to a broader base of the economy, and what we're seeing is as this rally extends, the broadening out of the rally to other names other than those top seven.
How about defensive assets or fixed income or alternatives? How are you allocating there?
Sure. So from a fixed income perspective or defensive assets perspective, we are overweight the sector generally. We have been adding predominantly still into credit rather than adding to duration at this point in time. There is an incredible carry in the space across both defensive alts and into fixed income, where we can generate income in the 5 to 10% levels with very little capital risk, albeit it is still credit, but we're watching it very closely. And so we're happy to bank that and just be a little bit overweight that sector and take a little bit of risk off the table. So we use fund managers from a fixed income perspective like Macquarie or Perpetual. And from a defensive alts perspective, we've been using a number of the private credit managers. I think you do need to be selective in private credit and ensure that you're with a manager who has a long track record and has a depth of team that can manage through a cycle and has proven they can manage through a cycle.
Who would that be?
Yeah, so we've used Metrics as one. We've also used Challenger as our second. So they're two that we're very confident and comfortable with for that space. But there are other mortgage-oriented players like Barwon, QRI we've used. So there are quite a number of instruments where you really can achieve quite a compelling return, and it's certainly additive to a multi-asset portfolio.
Just there, you mentioned a few different ETF, but also managed fund names. When is it worth paying that extra fee, that extra cash for active management?
Yeah, a couple of reasons we use it and when we do and when we don't. First and foremost is, does that manager deliver alpha relative to their factor bias? And when I think about factors, we need to understand if that's a quality global manager, for example, then are they actually beating the quality ETF? And if they're not, then it's often cheaper for me just to buy the quality ETF. So proportions of our sleeve, we will think about what factor we want exposure to and then adjust the portfolio and work through for that component of the sleeve. Do we want an active manager or are we happy with a passive ETF? And it really is about, does that manager actually outperform that style factor? But it also provides ease and speed in some instances as well. We're very clear, both when we're entering or exiting a market or when we're thinking about our asset allocation, of what economic data are we watching and what is our playbook? What are we doing to portfolios, or what are we going to do? If this happens, we'll do this. That could be adding or that could be taking away layers of the portfolio.
Let's stay with that. What data points are you watching right
Sure.
now to know when to shift those allocations?
Yeah. So a typical economic cycle starts in a housing market, shifts across to a goods cycle, then a corporate profit cycle, then employment, and then inflation. You look at the last 12 economic cycles in the US over the last 100 years, it's a little bit like clockwork.
Right.
This time is a little bit different, but it is following the path insofar as we've had the housing cycle and it's actually coming up the other end, and what we didn't see was job losses in construction. What we are then seeing is a good cycle that's been amplified because of COVID, which is a little unusual in its timing and the impact of that. So we're actually probably seeing somewhat of the bottoming of that cycle too. And then you see corporate profits. And we have seen some softening in EPS, there's no doubt about that, but it's certainly not been as bad as the market expected. So the next shoe to drop by definition of that path is employment. So will we see employment crack? So far we haven't really, but that is the data that we are watching closely. And there is a point in which, as jobs actually start to fall and unemployment starts to rise, that's when the equity market and jobs correlate quite closely. We're a little bit away from that, but that's the data point, that's what we are watching to determine whether or not we take risk off.
Do you feel like then the equity markets could continue rallying until we see that?
Generally, if you look again at previous cycles, 12 months out of recession, the S&P 500 in history median increase is 16% for the 12 months prior to that point, and we are already at that, give or take,
or
for
more.
this. Yeah, depends which day you want to calculate it from, but from a financial year to date, we're broadly there. So the path is actually, in history, we're still following it. It's just taking longer at this point in time. And so, we're watching closely, and that again is why I don't know whether we'll get a soft landing. Nobody really does, but what we do know is a soft landing looks exactly like a hard landing. until it doesn't.
You've been in markets for nearly 30 years now. Is there any lesson that you've learned from that time that you think you could share with investors?
For me, it's always about probabilities rather than setting a portfolio or having a view of a single view. It's what is the bear argument? What is the bull argument? Understanding the nuances of that and then watching the data. And then you can shift from one to the other. But if you hold any of it too firm, it's then really difficult to shift a portfolio because you're too emotionally attached to a view.
Well, thank you so much for your time today, Jackie. I really enjoyed that chat.
My pleasure, Ali.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content like this every single week.